Okay. Good morning, everyone. Thanks for joining. Okay, this week I also don't have presentations, but I think we have a list of good questions. And now it's like earning seasons, right? So there are more all these company-specific topics to talk about. I think in the past week we talked on Netflix a lot, right? Long discussion in the group. I have prepared one video just released yesterday. I'll still prepare, let's say, a couple more videos, like those short 5 minutes type of videos. So just pending some works on the editing side. So I'll do that. Well, these questions still come in. Where are the two? Still come in. Please lah. I'll remove all these questions. We keep all the good questions. The rest that's making fun of others, we won't go through that. Okay, let's start with the first question. Anyone got lost point to share? Mine, negative 25% year to date. I think in the past, we used to share all these loss point, right? Like daily losses. And then I think it has been quite some time that no one has sharing it. I think it's also because the volatility in the market is not so high until like last Friday, right? I think that was also like dropped around 3%. I think, let's say in 2020, there are periods that drop, let's say more than that, right? 4%, 5%. You see quite a number of people sharing their loss point. See how much they lost just within a single day. Okay, I'll go through my first. Anyone else want to share? Can also share later. I'll just pass. Well, walk around, see who want to comment. Okay, I know you guys are all quite curious when looking at other people's accounts, see how much people makes, right? Whether it's positive or negative. I go through mine first. So this is Interactive Brokers, right? Portfolio Analyst. We can actually choose to take a look at how much of the returns. So the headline numbers, right? I think started out this year for 420K, now left with 361K. This is like huge drop, right? So almost 60,000 loss. But this is actually including the money that I put in. I actually put in 24,000. So total loss here, you can calculate, right? It's around 82,000. But if you calculate from November, it's even worse. Then in terms of return, negative 19%. So not that different from our friend here. 25% year to date, right? So mine is 19. So about the same. I think in terms of where are the losses come from, I think mostly are those names like, even Alibaba's. I think I cut my position somewhere in between, right? Before I cut, there's some losses also. And then Chinese tech not doing that well. And then US growth stocks also not doing that well. So overall, I think my portfolio in terms of beta, right, is still higher than S&P 500. Because if you look at S&P 500, I think mostly those energy stocks and bank stocks are doing relatively well, right? Mine more towards tech, so the beta is slightly higher. So underperform S&P 500 during like all this downturn or downtrend period, right? I think this should be expected. But when I look at this number, like negative 19%, I was a bit shocked also. I thought my number was around, let's say, negative 15%. Yeah, so that's my return. I think nothing much. That's all I want to share. Unless you guys have any questions, you guys can also ask. I'll just see anyone else want to share your loss point. Boonsong, why not you start first? How much is your return?
My return now is, I think, minus 8.14%.
Just now you said Hong Kong index dropped by how much? Sure, we can look at the chart
no charts here because I always depend on Stock Cafe, and Stock Cafe is telling me that the tracker fund, which is the ticker code is 2800.HK. The performance year to date is minus 10.5. S&P 500 is minus 8.53, and Singapore index fund is 7.75. So this year royally gets smacked by Singapore index fund.
the best performing, right, Singapore, compared to all the one that you are watching at?
I can't say the best performing. Yeah, I mean, I have only looked at 3 index funds. So S&P 500, Hong Kong and Singapore. So Singapore one is the runaway leader. But then again, if you look at long term, ever since I started, the Singapore index fund actually has about 23% better than the Hong Kong index fund, but it's like maybe close to 100 or 90% less than S&P 500. Yeah, I mean, over the last 6 years that I've invested.
I'm sharing the chart here. It's really, wow, I still remember as of end of last year, everyone is saying that, okay, STI is not something that we can invest, right? It's moving too slow. It's exactly during period like this, right, where the market goes downturn for US markets, and then you can see that STI, it's not like saying STI is very good. It's just that they are kind of isolated from all this volatility that's happening around the world, right? Because for Hong Kong stocks, especially if you look at Hong Kong, I mean, Chinese stocks are like Alibaba, Tencent, all these, they are still not doing that well. And then on the US side, all the growth stocks crash badly. And now the one that's surviving is STI and all the boring stocks, I think.
Yeah, because if you look at 2020 and 2021, it seems like STI is doing very badly, especially 2020. STI is -8, whereas everybody else is pretty good, especially S&P has a 16% year to date for 2020. 2021 returns for S&P is like 20% more than what I call it, Singapore index fund. So during bad times it doesn't do very well. During good times it doesn't do very well. So people will tend to disregard STI. Yeah, normal lah. Every time somebody starts saying that a certain asset class is a dog, right, it's time to buy the asset class. So STI is continuing that trend now.
Yeah, there's momentum there. I think that's quite interesting. Anyone else want to share your year-to-date return? I'm looking at the chart. I see anyone want to give any comment with regards to your portfolio, what's happening with your portfolio, or only me and Boonsong talking? Let's say if there's any stock that you guys want us to talk about, you can also just leave the comment in the chat group. I'll try to monitor, and then we can look at the chart and discuss. Okay, if not, then we will just move on to the next question. Yep. Okay, the next one. With MANGA T and being Nvidia at the current state, price, news, development, what's one stock that you would buy now? I think this is also quite interesting. I think probably also because I have exposure in most of these companies, right? So we talk about all these FANG stocks quite often in the group, but I don't know anyone else that have exposure into this and have an opinion on these big tech companies. Okay, no. Okay, then I try and answer these questions. I think for me, right, I will focus more on Amazon and Microsoft for now. It's not like saying they are doing better than the others. It's just that I have a target allocations, right? And if I look at my target allocations, I think Amazon and Microsoft are the one that is below my target allocations. I'm trying to buy more into Amazon, but when I look at the financial numbers, I don't think they are that well. I mean, if you just compare Amazon versus, let's say, Tesla, right? I would say that Tesla numbers is actually the one that's outperforming the expectations, right? Expectation is already quite high, but they still do much better. The rest, I think Nvidia also not bad. If we just look at past, let's say, 2, even 3 quarters earnings, right? I think that's also because people don't have much concern with regards to the demand of their product. They are more like a supply constraint, similar to Tesla situations, meaning that, gamers that want to buy their GPU cards, they are not able to get that. There's just not enough supply, right? But one thing on Nvidia is that if you look at the news that's shared by YCX in the group, right, I think in terms of their GPU cards, right, starting around current period onwards, I think in terms of supply, they have quite enough supply already. So you can see that the pricing of all these GPU cards, right, relative to the MSRP is also came down a lot as compared to, let's say, the throughout 12 months in the past now. Because let's say if we look at the GPU cards, right, I think they launched around early last year. So the entire 2021, right, they don't really have enough supply. It's very, very hard to get all those GPU cards. Now on the supply side, they have enough supply already. Then if during this kind of period, if they can't sell more, right, then the problem is not on the supply, it's on the demand already. But one thing to note that is that their product cycle is around 2 years. So they know that everyone knows that by end of this year, they will have the RTS 40 series that's coming out, right? So there will be some customer that will say, okay, why not I just wait for another, let's say 1 year to upgrade my hardwares and so on, right? So that one will also put some downward pressure on the demand as well. But this is something interesting to watch at, to look at, because I think that Nvidia's result, at least for the coming 1 or 2 quarters, right, I think shouldn't be disappointing. That's my view. Hope that's we won't have situation right like Netflix or Facebook, right? Then the rest, I think they are just doing their things. They are, stable up kind of situations. But earnings numbers coming up next week. So let's see, is there any companies that will have will encounter very bad results? I'm so curious to find out. I don't want to speculate too much on this because it's just 1 week away, right? So and I don't have much insight also. Okay, anyone else just want to comment on these questions on big tech, FANG stocks, manga, I don't know, whatever you want to call it. Anyone else want to give your view? Okay, if no, next one. Netflix explained that part of the slowdown is due to pullout of Russia, worried about others tech that pull out also, especially AAPL and GOOG, as they are big percentage in S&P 500. Yeah, let me comment on the Netflix first. Yes, part of the slowdown is because of Russia. So if you exclude out the Russia impact, right, actually they grew, I think 200K subscribers in Q1. But I think the reason they dropped so much is not about that 200K, it's about the two things. One is they missed the guidance in Q1, right? Q1, initially they said they are going to add 2 millions. Now they don't add that 2 millions, they add I think 200K. But because of 200K or 500K, I think small numbers. So there's a miss already in Q1. And then they said they are going to miss or lose another 2 million subscribers in Q2. That's why I think all these analysts, they are already extrapolating this new message that come out, right? Because I think they only guide up until Q2. They didn't say anything about the entire year for 2022, right? So Q3, Q4, we don't know. It could be like they will lose another 2 or 3 million every quarter in Q3 and Q4, right? We don't know. And all these changes that they're going to make, right? Like getting into advertising, this cheaper tier, right? I mean, and the password sharing stuff, they are doing some stuff, some changes. When they do this kind of changes, right, there's always execution risk, right? For example, they might piss off their customer. So if that happen, right, if their numbers drop by 3 million, 5 million kind of subscribers, right, then I think that will put them in a very, very tough situation. I think that's the risk that we are talking about. That's why the share price has dropped, right? It's not about fundamentals as of now, as of Q1 has dropped so much. It's not the case. It's about there's much more uncertainty compared to just 3 months ago, right? That's why the share price has dropped a lot. But I think this is for Netflix. I think if you ask different investor, right, I've seen comments that is very, very bearish. There's also comments that is very bullish also, right? Like still having high conviction, right? So I think the opinion on this company is quite diverse. I think similar to Facebook, also the same. Like for Facebook, when people looking at the revenue, net income, they would think that, okay, they are still very strong. Free cash flow is still very strong. The valuation is almost the cheap kind of valuation, right? If you look at those who are bearish, then the situation also very extreme. So I think I think that's healthy, right? Different view is fine. I'm kind of neutral. I mean, with these two names. Netflix, I still have 3 shares. Not adding at the moment. That's my long-term portfolio, right? I'm not adding. Just for your information. So. Okay, others want to share anything on this topic about, let's say, AAPL and Google or Netflix? Okay, if no, I will skip. I won't comment Apple and Google. So I think I don't have any things new to talk about, like it's not like we have new development that we can speculate on their directions, right? But for Google, I look at their share price, I think they dropped quite significantly. So also shocked me a bit. I think I just not pull out the numbers, right? I think this is we can look at it together, right? Okay. So if you look at the performance, right, all these big cap, right, all these FANG names, if we look at the year-to-date numbers, of course, Facebook, since Q1, they dropped like almost 50% gone, right? But the rest are still quite, I would say, quite stable. They track with S&P 500 quite closely. Then, of course, Nvidia. I think this is for Nvidia is always the more volatile one. So when they went up, they also went up more than the rest. It's just like high beta kind of stocks, right? Then the rest, I would say that you see, Google, Microsoft, they dip almost 20% already. Yeah, I think this is the situation. But in terms of development, I don't have much to share. So let's move on. If no comments from any one of you. Anyone worried about earnings? Because last year earnings are so good. Apple, Microsoft, Google, Nvidia, Netflix, earning per share plus 50% to 100%. Slowdown in those numbers destroy them. I think slowdown definitely will impact, but for analysts, they usually are more forward-looking to the extent that 1 year kind of forward-lookings. Let's say if you just look at Q1 numbers, I think that's not the worry. So mostly it's like what kind of guidance that they are giving now. If they are reporting some slowdown in the numbers and then they say we are expecting further slowdown, right? Then of course I think situation like Facebook, I think it could happen. But I don't expect that kind of drastic. Shouldn't be as much. But don't expect that all these companies can only go up, right? Up and down is all quite normal. Anyone else want to share on this? Do you want to share a view on these questions? We are still on the line, right? Because I feel like I'm talking to myself already. Okay, if no, let's move on. Analysts are predicting 1 in 3 chance of recession. People who buy stocks last year has chance of lost years or decade. I'll go first. I think 1 in 3 chance of recessions, right? I think these are all make-up one. No way you can come up with like this kind of probabilities, because I mean, recession is not so easy to predict. If it is easy to predict, we can say that market timing is easy to make money, right? Using market timing, right? So, of course, there are some indicators that can tell us the probability of recession is nearer, right? So, for example, like those yield curve inversion, you can take that as an indicator. I think at least they can prepare us not to be shocked by anything that's coming. But the tough part is always the timing. For example, I can always tell you that the recession will come, but it could come in the next, let's say, 6 months, or it could come 2 years later, right? So that's the tough part, because if you say, okay, I think that recession will come and then I just park my cash in cash account, right? Then are you comfortable to just keep in cash for like 2 years, 3 years and just keep waiting, right? So I think that's the tough part, because the waiting period, if they have a minor dip in the growth rate and then suddenly just pick up, right? Then you just need to tolerate the situation that your money is sitting in a cash account, and then all your peers like are earning big monies from the stock markets, right? So I think it's hard to not FOMO in that time, and you could FOMO in at a much worse kind of pricing, right? Whereby the market already went up so much, right? So I think that's the risk when you time the market too much, right? So that's why I say DCA is still, from at least from psychology perspective, is much better. So all this number, I would say, no need to focus so much, but you need to have the mindset that some, how to say that, the mindset or something that, I don't know how to complete the sentence. You need to be prepared, at least to see that, okay, recession could come. If not recession, two quarters of negative growth, right? It could be one quarter, or it could be not like negative growth, but close to negative, right? Like 0.1% kind of growth, right? So stuck there, technically not recession, but still some slower growth, and that slower growth can also lingering around, right? Like for example, you get 0.2% growth for 3 or 4 quarters, right? The economy just becomes stagnant, right? So and that also could hurt the stock price, because whenever you don't have much margin, right, that your growth now is stagnant, right? People always say, oh, it could like just become negative, right? GDP growth could drop, right, in next quarter. So when uncertainty increase, then stock price also will be affected. But I would say that this one, I don't know, just be prepared for volatility rather than trying to time it. Okay, anyone want to step in here just to chat a bit on this question? Okay, let's move on. Is some stocks in the market cheap now or too expensive before? Yeah, I think this question is a bit generic, right? I think we can look at some companies and look at some examples. So I think just now I pull up, like this is from Seeking Alpha. If you go to the charting, right, you can actually look at different metrics. So I think it depends on which company that you're looking at, then you might want to choose different metrics, right? But the simplest one, I think, especially for companies that are making money, right? For example, like Nvidia, they are making money for sure. Just look at 5 years, right? And then I look at their PE. You can see that, let's say 2017, 2018, right? Like their PE, it was around, let's say, around 50. Also not low, because their growth rate was quite high throughout this period also, right? But you see, I think closer to the end of 2018, this is the period of monetary tightening, and then there's also some slowdown in the growth as well. So you can see that their PE, right, they can peak at around, let's say, 50, and then it could drop to around 20, right? So this period, this kind of drop in valuations, right, it could happen to any period, right? For example, you see now they have a very high, very nice run up after COVID, right? Then PE is at 100. Why the PE went up so much? I think also attribute to their, all this the entire new line of business on the data center, doing that very, very well, right? Like all the hardware, software that they are selling is really becoming more important when it comes to machine learning, AI stuff, right? So they essentially create like a new business line that is even bigger than the graphic card business, and hence you can see that and also their earnings also has been doing very well in the past 2 years. And now from PE of 100, you can see that their PE now is already at 50. The question is 50 here same as 50 here? Or actually the 100 here is equivalent to 50 here? Because from 50 drop to 20, you should be prepared to see 40% drop, right? Now you can say that we already see 50% growth and 50 PE is already kind of reasonable. You can say that, or you can say that actually no, even 50 is still high. All this is because QE Fed already pulling out the QE liquidity. Hence, we should expect them to go back down to 20, right? If that's the case, then even 150 is not cheap, but who can tell, right? Like what kind of PE is appropriate, right? Because even if you compare different period, their growth rate is also different, and then their prospect also different. So it's very hard to generalize and say whatever PE that is it should be appropriate, right? This one is really up to each individuals lah. But for the other companies, right? Let's say if you look at Amazon, right? And for Amazon, I think people's not looking at PE so much because their PE number, the E, right, is just not so meaningful to look at because they reinvest so much that sometimes their earnings will just drop to negative, and then you don't see like it's very how to say, when the E is too close to zero, they flip between positive and negative, right? The PE is really not so meaningful one. What I've observed is that some people use this is enterprise value divided by EBITDA. So I think they take up the depreciation and amortization, and this EBITDA number is much more smoother as compared to the earnings, right? And if you look at these metrics, right, in the past, they are also quite high, let's say in the range of 40, right, around 40. And then you can also see that during the COVID run-up period, they can go up from around 25 to 45, right? And since then, this EBITDA also keep increasing, but the share price in the past 1 year, actually, they have been keep coming down, right? So if you look at in terms of valuations, it's already dropped to 25 EV over EBITDA, which I think is, I wouldn't say it's very cheap already, right? Because it's always hard to say these companies are cheap, right? I think you can also only see a cheap company where the company's revenue is growing, earnings is growing, free cash flow is growing. Then suddenly the share price, the PE is like, okay, single digit, the kind of companies. Then I would say, okay, really cheap. Even you can say Alibaba is cheap, I would agree. But even for Amazon, I can only say that relative to, let's say 1 year ago or 2 years ago, right? Valuation has came down a lot, and now I can say it's reasonable looking at this chart, right? I can't say that this is in absolute terms is cheap, right? So you see, even for tech companies, Amazon considered tech, Nvidia considered tech, right? You are actually seeing a different picture here, right? If you believe this is a good metrics to look at, they are quite affordable, right? Quite reasonable. Any companies that you guys want to take a look at, then we can see, right? This one, maybe we look at PE for Microsoft because they're also making money. So you can see, right? Yeah, same thing, right? This is COVID period. They are as low as around 24, right? Then from 24 just shot up to 40. Then now came back to 30. So is 30 reasonable, right? Or you can look at 2019 period, also around 24, right? So even if you just say, okay, it should go down to 24, then I will buy. Then you might want to wait for another 20% drawdown, right? 20% drawdown out of this 30 become 24. So I think this is just, I mean, looking at PE, looking at all these metrics, it will give you some, how to say, some feel on where the valuation is, right? But I just don't want you guys to like treat this one as like, okay, this is how I should look at 30. It has to come down to 24. Then only I will buy. Like you try to optimize for like, okay, 30 is too much, I will buy at 28. These kind of things are because, you know, if a business is good, right, and if you are really buying it for like long period of time, you just want to accumulate stocks, right? I think sometimes just overpaying a bit, as long as the company is good, the prospect is good. In terms of risk, you are not looking at some things that is very concerning. For example, in a situation like Netflix or Facebook, this kind of situation, right? If no such concern and the story is still playing out, right? Sometimes just pay a little bit of premium. I don't think that is such a big how to say, it's not a bad idea just to pay a bit of premium and just buy first, you know, just have some exposure first. No need to go all in, right? And then over time, as they execute, their earning increase, you look at there's good result, and then you can just keep on DCA and build the portfolio, right? No need to time all this like well, it should be how much PE, then only I buy that. So I think that's my suggestion, right? Because if you pay too much attention to this also, right, then in a way you become a market timer already. Like if you say, okay, 30 is expensive, then suddenly really drop 25 and you bought, right? You think that, okay, you bought 25 and then PE move back to 30, okay, it become a gain already, you're happy already, right? Then suddenly you go up to 40, then you were thinking, okay, why not 40 looks a bit high, why not I sell a bit first? and then wait for it to come down to, let's say, 30 and then buy back in, right? Do that kind of things just to optimize and hope that even if the market just goes zigzagging, I can get some return from getting in and out, right? Then, I mean, if you're having some small success doing this, right, then your style of investing will be more and more towards this kind of in and out, this kind of market timing. Even though you are not market timing using technical analysis, looking at chart, but you are market timing using all these valuation metrics, right? I also don't think that's a good idea, because there will be period that, like Tesla situation, right? Like, okay, the company just execute well, it go up, the PE just go up, and then you sold already, you can't get back in. It's too painful, and then you just look at the company just continue to 3x, 5x, then you just miss the boat, right? It's even more painful for those that never look at the companies, right? Because you invested before, and just before they ran up that 3x or 5x, then you just get up, right? I think that's the risk that you are playing if you are getting in and out. So I think that's my suggestion. I think the philosophy that I try to promote is take this as something that give you a feel on some assurance that the market is not as frothy as many people are describing, right? And then at the same time, just focus on building the portfolio, accumulate stocks over time. Just own the companies. If the company is good, just own it, right? Just hold it. You will do well. Okay, long comments from me. I'll just look around, see anyone want to comment. Help me out a bit. Yeah, I think just now was commenting on these questions. Is some stocks in the market cheap now or too expensive? Just now we look at some example. Any other example that you guys want to look at can also let me know. But I think when I talk, I cannot multitask and looking at the chat. If not, we will just continue. Okay? All right. Next one. Any reason why your allocation to Google is quite low compared to, say, Amazon, Apple? Thinking its valuation is starting to look quite attractive. Yeah, I think this is a good question. I think it's really looking at the business model and not so much on, let's say, their valuation or their metrics. I 100% recognize that Google, right, in terms of their business model, it's just like superb kind of business model, right? You just look at search. You just look at Google search alone. It's really it's a product that the more people using it, right, then with the data that people are feeding in, right, they can just make their product much better. So I think when it comes to search, right, even sometimes I also don't know when I open up the Bing, the Edge, right? Sometimes the Bing came out. I did some search before. I don't think they are close to Google search quality, So I think in terms of product quality, they are top tier. And then with regards to YouTube, right, it's just that it's so much better than the others, right? And the content on YouTube, these are like all produced by YouTubers. They don't. I mean, YouTube, they don't have to spend monies, spend capex to produce content, right? All these content are generated by the YouTubers, and then these are great contents, right? On the platforms, right? So basically, they just run ads, and then the free cash flow just powering in, right? So I think in terms of business model, I don't have. I think it's really like you could even argue that they are better than companies like Amazon or even Apple's, right? I don't doubt that, but it's just that for me, I look at their, let's say, I don't know, I won't call it culture. It's just that their business model, in terms of their values, maybe, right? I think mine is more aligned with Amazon as compared to the others, even Apple's, right? So I think that's my own preference. This is a bit on the emotional side already. It's not so much on like really logically looking at each one of them, right? That's one thing now. So I would say this is totally personal. And then the second thing I would say that if we look at their, let's say, roadmap, right? If I look at Amazon, I think even just the cloud business alone, I think their growth prospect is so much larger as compared to, let's say, Google. because they're just barely starting, in terms of AWS, we are not, if you can say that they haven't started. It's so small compared to ultimately what this business can become. So I think that they have this huge total addressable market that they are still working on. So that's one thing I like Amazon a lot. And I don't think they want to maximize their earnings. For them, they're always like reinvent and then put their capital back to the companies, and then just create the futures, right? Just be very innovative about it, right? So I think that's Amazon culture. But when it comes to Google, I think they have a lot of side bet. For example, like those I think like all this self-driving, they've been doing it for years, right? But I don't see something that, at least on their core business, I don't see they have a very, very strong core business that have huge prospects. It's a bit like a side bet, a small side bet here and there. Maybe their cloud business, they're trying hard on that just to grab market share, right? We can see that. But I don't think they, in terms of their core business, they don't, I don't see them like really expanding a lot now. So I think that's the feel that I got. But in terms of business, I don't have a comments. In terms of, I don't have complaint. I think they are great. So if you believe their business model, all these things, you think good return, I don't think that's anything concerning, right? It's just that maybe, let's say, if there's any downturn in the market, right, because their business is still based on ads, right? If their customer cut on ads, I think that they will hurt their financial. I think very hard to escape this. And this is nothing special, right? Let's say if there's any recession coming in, then Apple will sell less iPhones. I think their financial also get hit, right? So I think all these are normal. But don't think that these are tech companies, hence they are not affected by recession. Right? So that is the thing. Yeah, again, long comment from me, even though I don't have a very strong opinion also. Anyone else want to comment on Google or compare it to Apple, Amazon? Sometimes I wonder if I don't hit the record button, I don't put on YouTube, maybe we can have more interactive kind of discussion, right? Because if not become Boon Tee show already, just one person talking. Ayo. All right, next one. Market crash. Good questions, right? We can look at all this, right? Look at a chart. Let's say just look at S&P 500, right? I like to look at all this, market drawdown. Sometimes you look at, market drop by 3%, looks like crash, right? And then everyone chatting in the market, all red. You look at the Finviz maps, right? You look at the Finviz maps, it's just so scary, right? This is like a one-day drop. Like, every industry get hit, right? Wow, it's just painful to look at these things, all red. Then you look at the drawdown, right? Drawdown, okay, for those who are not sure, drawdown, they are just looking at the maximum point in the past and then just measure like now compared to the maximum or highest point, right? How much it has dropped, right? So you can see that for now, right? Actually, the drawdown for S&P 500, is this correct? The correct one, right? It's actually only at 11%. So you can actually verify this, right? So this is the chart. If you look at their percentage drop, right? You see, it's only around 10% drop, right? So actually, if you just look at their drawdown, it's only like less than 12%. It's not a lot, right? Compared to, let's say, COVID crashed, right? They crashed 1/3, right? So 1/3 crash, and it happens like within days, like between weeks lah, not days. From around February, then they just the drawdown just happened, right? You can look at the chart, right? Very, very sharp drop. And once it dropped to this level, you can see that whoever DCA or whatever strategy that you are playing with, right? As long as you long the market with in the past 2 or 3 years, right? Then your account all dropped to negative already, right? But if you just look at the drawdown, I think let's say at least for now, it's just not much. For ARK ETF, maybe yes. For ARK, I think they dropped quite a fair bit. Year to date, I think they dropped like 50%, right? If you look at their drawdown, 68%. But let's say in the past, okay, no. I think they only started around 2015, right? I think drawdown like 40% happened a couple of times, at least like 2 times, right? But this round is really like 68%, almost like, not almost, already 2/3 gone, right? Left with 1/3, right? So I think this is like serious drawdown for sure, all these high growth names. Let's say if we just look at QQQ market crash, current drawdown around 20%. So this is already at bear market. But if you look at in the past, you see the dot-com bubble burst, right? Their drawdown can go up to like 83%. And it takes like how many years? 16 years to recover back, right? So this is like really, really long. So we don't know if it is a serious bubble, it could take decades to recover. But let's say if it is like those very sharp crash and then it recover, right? You are looking at a period like, let's say, end of 2018. So they recover quite fast. But come back to the question again, right? Market crash, or is all this, could it turn out to be like lost decade? No one will know one, right? Yeah. But I think if you invest in individual stocks and you cannot take it, right, then probably just invest in S&P 500. At least you are looking at drawdown numbers that is much lower compared to individual names, right? Because if you invest in individual names, let's say just look at C, right? I think we discussed C also in the past. You see, current drawdown, it could be 76%, right? Meaning that if you invest in like very sway, you invest in the, you know, the highest point, right? Then you put in 100K, now left with 25K only. And if you leverage, then make even worse, right? So yeah, if you cannot take it, have a diversified portfolio, and then people say that, okay, they are going to do sniper theory, that kind of things, then if you can't take it, then just let other people earn the money, and you just no need to earn the kind of money, right? Sniper theory works well if you have a very, you are very lucky and the stock just ran up and then you will be a happy man, right? But let's say this kind of situation happened, then, I mean, it's quite painful, I would say. Okay, yeah, just a short commentary on this. Anyone else want to comment on market crash?
Hey, Boon Tee, Martin here.
Hi, Martin.
Hey, just one question, maybe about ARK counter, because I always see them trying to, example, Tesla go up and they sell away, then they buy other counters. Do you think that they are doing market timing? And then later they buy in. So I think the more they trade, I see their counter going lower and lower every time.
Yeah.
What is the view about ARK, or anyone's view about ARK counter?
Yeah, I think for ARK, right, if you look at their results, and if you just look at the result of their individual holdings, right, I think they, except for Tesla maybe, the rest, right, like Teladoc, Coinbase, all these names, right, I think their underlying also drop a lot. It's not like underlying stay flat and then they just trade in and out and they just destroy like 60% kind of return gone just because of trading in and out, right? Because they can't leverage. They can't leverage. So this is not a leverage fund, right? And then they can't do all this option stuff, right? So their money is mainly due to the timing. I mean, at least let's say if you look at past 6 months, that return dropped a lot. I think it's because their underlying also dropped. It's not so much about buying in and out that caused that huge drop, right? So I think that's the impression that I have. But at the same time, I do recognize that if you look at their trades, they are in and out, in and out. And then if there's in and out, of course, you will see there will be examples that they buy low and then buy high and they sell low, right? So, but there's also situation where they sell low and then subsequently the price also drop, right? So essentially that trade actually make them some money if they compared to if they don't do anything on it, right? So I think that's also something that people may not pointing out, because they are only selecting a couple of trades and say, okay, you see, they bought this company and then they sold later at a lower price. and then make a narrative, right? So I think in order to really tell you that whether there are all this market timing in and out, whether it will generate some alpha or not, right? You cannot look at examples, right? You have to look at, do some quantitative study and look at every trades. And then from every trades, right, you can calculate, see whether this timing component, whether they add to returns or not, right? And I don't have, I don't know that. You need to run through the numbers, then only you can tell. Then the third point, right, is that I think sometimes they go in and out. It's not because they are bearish on that companies. For example, if people selling ARK ETF, right, and the share price drop relative to the underlyings, right, and this ETF mechanism, right, like the creation of the units and redemption, they will kick in automatically. So once they kick in, right, effectively from ARK perspective is that they have to sell. So meaning that their investor pull out from their funds, right? They have to sell. So whether they sell Tesla or they sell their Teladoc or they sell their Coinbase, right? They have to sell either one. And let's say if you compare to their purchase price, right? Let's say out of these three, right? They all purchase some shares back then when their price is higher. So either way, they have to sell one of them, right? They just choose one to sell, and then it can still be used to paint a picture that they buy high and sell low. You see, so it's really not that fair to say that, okay, you just look at these three example, they buy high and sell low, and just attribute all this to their market timing. It's very hard to say one. All this narrative, right? Just need to be careful, because you cannot look at example and conclude from there. People runs all this, right? Is let's say if come to investment industry, right? Anyone that's doing all this performance analysis, right? This is like a dedicated team that go and analyze the manager's performance and try to attribute how they add values. Like are they adding values from stock selection, from market timing? Is there any style drift? Is there any a lot of all these things, right? You can actually attribute one. Like all this, breaking it down and then say, okay, these managers, they are doing well in which area. And then that kind of reports, from that kind of reports, then we can tell that, okay, whether they are doing a good job or not. If not, if we don't have the data to run that kind of reports, right, what we can say is just that, okay, I don't have all this attribution, I don't know. But at least what I can know is that from investor perspective, if I invest in ARK ETF, I just want to know my returns, right? Then what you can do is just look at their track record compared to S&P 500 or compared to QQQ, and then you can judge whether they are doing a good job or not, right? And if I look at their returns since inception, right, we can actually look at it here. So let's say yeah, long answer, but let me close this answer this question by just looking at this return, right? You compare their return versus QQQ, right, and SPY, right? And if you look at since, let's say, inception, right, from the fund start, right, actually they're still outperforming S&P 500, SPY, but they are now already underperforming QQQ, right? And we don't know, like this downtrend, this is like negative momentum, right? If you understand, let's say, take a bit of reference from technical analysis or just like factor perspective, right? Momentum, right, is down. If you want to predict their movement in the next 6 months, right, they are likely down compared to up, because there are people that will be shorting their stocks, right? So if this momentum continue, I don't know, they can do worse than S&P 500, right? But now we are looking at, like, don't know how many years, right? 5, 6 years, even longer, right? I don't know. Like let's say 6, 7 years of track record, right? They are still above S&P 500. If you go and pull out like 3,000 a list of 3,000 managers, how many of them can outperform S&P 500, right? I don't think you get a long list, you know. I would say more managers underperforming S&P 500 than outperforming S&P 500. My portfolio, I started out late 2017. Now it's also underperforming S&P 500. It used to outperform S&P 500. Now already underperform. Not so easy one to do better, but they are better, right? So this one you have to give credit to them. right? Yeah. And their call on Tesla, that was like a great call, right? So give some credit, though. Maybe they are able to spot the next Tesla. I don't know. Maybe not. So also hard to say, right? Yeah. That's my comment. Anyone else want to share your insight with regards to questions that Martin just asked on ARK? Anyone else want to share a view?
Boonsong here. I think the only real problem I see with ARK is the Palantir trade so far. That they really moved the entire block of Palantir out. Even though they just bought like maybe weeks ago. So that was like the only red flag that I see with ARK. I can't say for the rest of the trades that they've been doing recently. They usually just trade small blocks. So I don't think there's a huge problem with ARK as of now. But to say that Bitcoin will be worth a certain amount of money, or Tesla will be worth a certain amount of money that is so far-fetched from today's figures, it's quite mind-blowing. So I don't know whether you want to have that kind of expectations. Yeah, that's all from me.
Okay, thanks, Boonsong. So sorry, your side is a bit noisier, so I also do, can't maybe I don't get 100% of what you just said. Yeah, but I think just to and one last point on ARK is that I think you just can, for whoever like considering to invest in ARK or to, let's say, have investment in ARK, now thinking of want to pulling out or not, right? If you are making that kind of consideration or decisions, right, I think just read their stuff, right? Or just go to YouTube, search Cathie Wood, ARK, and then just listen to Cathie Wood explaining their thought process. I think for her style, right, I think investor is either like you get it or you don't get it kind of things. So if you really like truly believe like she know her stuff, and then whatever thematic investing that she try to promote, like all these disruptive innovation kind of things, right? If you really believe that and you don't want to like copy her trades, right, I think the best way is just to buy ARK ETF and just stay invested. I think that should be the way, because if you keep on busy copying her trades, right, I think it becomes too active. I think some traders do that, I know, but I think there's so much headache to just copy that, right? So if you believe her style and then you believe her thesis, right, just buy the ETF. If you, after listening to her talking for, let's say, like 1 hour or 2 hours, right, and you think this is like bullshit, right, then just stay away and also fine. I think it's a bit like cult, very niche kind of investing. Either you get it or you don't believe it. So I think either way is fine. So yeah, people can debate about it, right? But I don't think you can persuade people to jump into her camp or jump out of her camp. So it's quite binary one, I think, at least in terms of the view. Okay, let's move on. Next one. With growth stocks taking a hit, so is my leap course. What should I do? Okay, I'll go with this one. I think I want to explain a bit. I think for I try not to see these options or leap course, right? This is options, right? My perspective is that, some people use option for different reasons, right? Some people just want to trade position in and out, and then they use option to like leverage it, right? So I think for traders that's quite common. You just want to magnify your returns, right? So especially for those who have small base of capital, they just want to earn big money, they do leverage. I think this is their things. But for me, I will try to explain this from the perspective of like, you are doing this mainly for leverage, because it is leap course, right? You leverage, and it is a long-term kind of positions. Say, for example, you are long on Microsoft, and then you just buy a leap call, and then you just use leap or options as a leverage positions. Then now the question is that, okay, if, or maybe not Microsoft, say for example, C Limited. Okay, let's say you buy a leap calls, and then now the share price has dropped, right? This is similar to you are buying it on margin, because if the share price drop, then of course your return would drop a lot, right? Because of the leverage position. Then now what you want to consider, which is a bit more complicated as compared to just margin, right? Is that for leaps call, you need to ask yourself like, okay, now how much is the strike price, right? So let's come back to, let's say take C Limited as an example, okay? So let me remove this. Okay, now the share price has dropped so much, right? Let's say you buy it at 200, and let's say the strike price was also 200. Okay, then the problem is now is that the share price has dropped to 87. Do you want to just keep holding on to your leap cost? I think the position like this, right? You need to be aware that as long as the share price stay below 200s, right? It's just lingering around this area in the next, let's say, depending on your time, the maturity of your leaps cost, right? Let's say your leaps cost is 1 year, and then it just goes zigzagging below 200, right? What you are suffering here is actually the time decay. So you want to be very careful on that, because whatever that leap cost, right? Because I don't know, some people, they might have just one contract here. Some people will just have like 5 or 10 contracts, right? So if you have like 10 contracts, 20 contracts here, and then your leap score value, it could be like 3,000, 5,000 here, right? If it's zigzagging here for some period, that 5,000 or 10,000 or whatever market value of the call options, right? They will decay to zero. So you need to be careful on that now. So there are some website, I think some I shared in the group before, right? So it help you illustrate that, okay, if the share price just stay constant, how much of your call option will drop over time. You need to know the dynamics of all this option strategy to help you inform like what you should do. In this kind of period, this kind of situation, if your strike level is high, I would say that the time decay is something that you need to watch out for. So that is, I think, the most common mistake that people do. And then the second thing is that, what can you do, right? So I would say that if you need to judge the situation, right? Because like, if we come back to 2021, where the company is just benefiting from all this upward momentum, right? It's easy to make money. But now with the situation, just look at the macro environment, tightening, all these things happening, right? I don't think, like, let's say stocks like C Limited could drop another 50% from current level. I honestly don't think that, because in terms of valuation, even if it is not cheap now, it's also not so expensive already, right? There's some echo. Okay. Can you put on mute? Okay, thanks. So I think that for come back to C is that if you, after reassess the situations, and then if you don't think that it will just go back to above 200 or above 250, right? And you don't bet on that happenings, right? If your strike level is 200 or above, of course, implicitly you are betting it to go above the strike level in order for your options to have any positive payoff, right? So what you should do here is that you need to make a decision on whether you should really cut loss, right? So cut loss meaning that you need to sell the position, and then if after you sell your position, let's say you have two options, right? You could sell these two options, and then you can buy it back the stock at, let's say, a lower strike price, right? In order to minimize the time decay, you know. So these things you can do. Or if you are very bullish on the companies, right? I think it also makes sense for you to like sell this current call that you have and then buy another calls with a lower strike price, just to, you know, reduce the time decay situations and the time decay cost. So I think this is something that you should consider also. But with this, I mean, this is still a very generic questions, right? I don't know exactly what is your situation. It could be that your strike level is for C Limited, it's not at 200, right? It could be at 50, right? Then the story is very different already. Or it could be that this is not C Limited companies that you're having, right? It could be another companies. Then you also need to assess that companies. So I think I can't give too much opinion on this, given that I don't have that details. But I think the time decay is something that is so generic that too many people that make that kind of mistake. They have this tendency to believe that, oh, it was 300, now it's at 80. I think at least it will go back to 250, right? Then I just hold. I'm just bullish. But usually the most painful thing is that yes, it came back to 300, but it happened right after your options expired, you know. So you are right in terms of the direction, you are right in terms of the magnitude, but you are wrong in terms of the how soon it could happen, right? Then anyway, your entire position already wiped up because of the time decay. So that kind of situation is you screw up in terms of the executions of the options. So that one I think you need to learn with regards to cost or any option strategy, right? You need to know the dynamics. Or if you are here, you can share your situation, then I can give more like details comments. If not, I will pass, skip to next question. I'll pause here for a second, see anyone want to comment on this. All right, become solo talk already. All right. Hello, anyone? I saw Billion Achiever is here. Hi, Miss Billions. How are you?
Hey, morning. Yeah, it's
morning.
Nice to hear your voice again. Yeah, I don't know anything about it, so yeah.
Yeah. Good to have you here. Help me alleviate some burden, you know. If not, I'm like become DJ, keep on talking. Yeah, sometimes I need to take a break.
Yeah, you sound good. I mean, you have a better knowledge also on those options and things. Yeah, I'll help you out maybe about the DCA or whatever entry things. Yeah, later.
All right, thanks. Hi, Jeremy. Morning.
Yeah, so I think another thing is also whether you have the money to exercise the option. So if your leap call go wrong, and if you're planning and you are still very bullish on the stock, maybe you can just exercise the option and hold it for long term. But that requires a lot of capital. So I do not know the situation of this person also.
Yeah, I think for leaps call, I think the capital to really exercise, I think that's more applicable for put. Let's say if you sell a put options and then it drop below, and then you need to have the capital to take on the shares, right? And just pay the strike price, right? So I think put also different compared to call. But anyway, we don't have the full details. So next time, right, anyone asking these questions, right, I'll say if you can give more details, right, because you can still ask as an anonymous. If you just give more details like this store maturing when, then you can give you will get a more detailed answer that's specific for your situations, right? So can give more details next time. Okay, let's proceed. Can Boon Tee share his latest trades or portfolio adjustment this year and his plans going forward? Still DCA? What his current market thesis now till 2023? Yeah, this question I think I have to answer, right? Because he's asking for mine. For those who are new, right? I don't know. Some of you might be new to the group. I mean, if you compare my content, I think my content is definitely not as good as other YouTubers. There are many YouTubers that are doing great job, right? Mine is just not so good, right? But when it comes to transparency, I can say I probably are like top 10% in terms of transparency. Definitely not 100% kind of transparency, but close to maybe 90%, because like I mentioned before, if there's any short-term position, I don't share that. But these are all long-term positions. By long-term position means that you look at these numbers here. Usually, if you track it by let's say every 2 months, you just have a glance, right? I believe there isn't that much of changes here. Mainly share price fluctuating. So this is my portfolio allocation at the moment. There's even a new chart that I put in here just to show how it play like from the past, right? Since the market, since I set up this account, right? So how it progressed over time, right? So definitely not doing well. As you see, like now market downturn, and then I have lost like 20% since year to date, right? So my position size is, let's say, back to last year, mid of last year already, even though I still keep on putting in money into the portfolio, right? Still keep buying, right? Then I have another page here showing the trades that I made. I don't show in the past. I think maybe not so relevant, but these are all the trades since beginning of this year. Anyway, let's say if there's any trades, I usually share in the group anyway. But if you are interested, then you can take a look, right? These are all the record, right? So transaction price is all here as well. So I would say the recent trades, right? I think this one I share a lot. I even have a Substack a post talking about I selling out my Alibaba, and then my Facebook also I sold already, and then my monies went somewhere else, right? And after I sold Alibaba, I bought some Nvidia, CSPX, CNYA, all these names. There's some reallocations around my portfolio. And then the most recent one are like, when Tencent dropped, I also bought like 100 shares here. This is Hong Kong one. And then the most recent one is Nvidia and TSMC, which I just bought 1 or 2 weeks ago, like 10 days ago, right? So these are my trades here. I think I can, next time if there's any trades, I will just put in here. I believe you can just look at this just to see what kind of transaction that I have. So this is for those who are curious. I mean, if you look at this, please be aware that, my returns is even worse than S&P 500. So if you want to copy, I can't stop you, but I would just say, why not you just copy S&P 500, right? Which is a better portfolio, better manager than me. So I don't have pressure to share these kind of things, right? Because I'm not saying that I'm better than the markets, right? So I actually, sometimes I even think that I'm copying the market as well. Like my portfolio, these are mostly like investing into like larger cap rather than those small one, right? So no shame on that. But back to the questions, right? What's my current market thesis now till 2023? In terms of the monetary tightening, I would say that actually since beginning of this year, I've been saying the same thing. Monetary tightening is coming. Fed is open about it. They mention it in their minutes. And then I still think that the market haven't fully realized the kind of tightening that we are seeing. But now they are slowly to realize that already, but still not 100%. So in other words, right, please be prepared to see another, let's say just go back to S&P 500, right? Just now we mentioned that it's only like 10% drawdown, right? I think these numbers, right, 10% drawdown, right? I think even it dropped another 10% from here, I think this, you should expect that to happen. I mean, I'm not saying this for sure will happen because it could always like just bottom and then go up, right? Who knows, right? But I just want to say that given that this monetary tightening is very powerful one. These things is, they always say don't fight the Fed, right? You see, 2020 COVID happened. The Fed can just pump from here like around 2,500 to like 4,000 or even 4,500, right? This is the power of the Fed when they want to pump. Now, this is the period where they are dumping. So I don't think they want to dump until like back to COVID period low. They also, this is not their goal, right? Their goal is try to cool down the inflation, right? But when they hike the interest rate, they are dumping, right? They are not dumping equity. They are just dumping the bonds. So when they dump the bonds, the bond yield will increase. Some money will flow to the bonds. They're flowing from stock. They're flowing from other areas, right? So just don't be shocked when, let's say, S&P 500 just drop another 5 or 10% or even 15% from current levels. We should, please don't be shocked. I think that's what I want to say. So, but with that said, I don't think, even with my portfolio, you see, I'm very transparent about it, right? I won't say that because of this view, I will sell everything here and then just wait for the bottom and buy it back, right? Because if I sell all of this, every week I need to watch the market like a hawk and just make sure that I enter at the exact right time, right? Who can make the kind of calls, right? Probably I will re-enter too early or too late, right? So that's why it's so, so tiring to do that kind of things. It could already bottom. That's why I said I try not to do that. So that's why I think still come back to just DCA. If it drop, continue to DCA. You're doing this not for the next 1 year, right? We are all doing this for years ahead, right? Now it's 2022. We are recording this video. I hope that 3 years later, 5 years later, we can just tell all the new joiners that, okay, just look at the old videos. The strategy is like this. 3 or 5 years later, still the same, still the DCA thing. And you just look at the portfolio, it used to be like starting out from a small base also, right? Like 200. 5 years down the road, I can tell you for sure this number won't be at, like, let's say, like, I don't know, like 300K, right? It will be much higher just because of the DCA and the market over a long period of time, they will go up. So that's just a very simplistic kind of explanations. Okay, back to this 2022 lah. Don't go until 2023 lah. Monetary tightenings will be tricky. Okay. Market still adjusting. DCA, don't stop DCA. If you are uncomfortable, I would say DCA at just a smaller amount. Maybe you DCA some money into your cash. If that helps with your psychology, right, or with your emotion, I think that one you can do. But don't keep cash for long term. Cash won't beat equity for long term for sure. If you keep cash now, if you see the market becoming more attractive, maybe stack up your DCA into equities. Okay, that's all on this question. Anyone else want to share your view on this?
Yeah, this is Billions. Yeah, for me, I think why DCA work is that I think the first thing is the emotion. I think many people die in the investing because of the emotion. They stop and they froze. They do not know what to do. So maybe they take a side and say, okay, let me just wait and see whether, you know. And when the market drops, they say, hey, hang on, I didn't put in all my money. You see, people losing money. But when the market bounce back, it can bounce back really hard and really fast. So the thing is that when that market comes back, maybe 5% in a day, it can come back 5% in a day, you know. These days, I do not know what happened to the stock market. It can go really fast and hard. And you miss out that 5%, and this 5% or 10% increase in 3 days is a forever missed opportunity in your portfolio. If let's say your portfolio next time grows to 1 million, actually you can earn, you know, 1 million and another 10%. But that's missed opportunity for that few days. It's the opportunity that you have lost forever. And just because of that, you are so happy that, oh, you avoid the dip. So I guess that for us, DCA still work. I mean, at least for me, I cannot speak on behalf of other people. It keeps your emotional away, and yeah, you feel relaxed and you just keep on putting in. I guess that's another group of DCA that, like what BT said, right? Maybe when you think the market is too high, you just reduce the sum, and you think the market is generally dipping more, and you wanted to accumulate more, and you feel better, then you start to invest a bit more. That works also, but I will just say that do not hold back. Yeah, you might miss out the opportunities that you should have get during the bounce back. Just look at 2007, 2008. Those who never leave the market, see where they are right now. They are making a killing. Yeah. So I mean, this is my opinion. Yeah.
Thanks for the comment. I think that's very true, right? Because whenever we look at market, we look at the chart, whatever, right? There's always this long-term versus short-term kind of view, right? Because if you just look at short-term, right, whatever we are commenting just now, right, saying, okay, all this Fed tightening, all these things, right? This is like really a short-term thing, right? We are talking about like the Fed meetings in May and then in June, right? And then let's say we can comment up until, let's say, Q3 this year, right? This is all like just within a couple of months away, right? But people always miss out that, okay, actually, is it really important to make the kind of like optimize for all these monthly topics or monthly developments, right? Because over a long period of time, is it really important? Let's say if you just buy here, right, this point here, knowing that actually that time also market was downtrending, right? If you look at the short-term basis, just look at 2018, right? If you look at a short-term basis, if I'm making the same comment here, right, I would just say, market timing, monetary tightening, market may drop. How can you sure that you can buy it back here or buying back here? All this market timing, like perfect timing, is very, very hard one. But what we can be sure of is that if you just zoom up a little bit, right, then you will notice that actually not so much what. Even I bought it at slightly higher, even I bought it at peak here, it still go up, right? This is what long-term investing is all about, right? Then come back to this period. It could be that, we are seeing that these things, right? Let me draw something. This drop, can it drop here? Definitely can, right? Zigzagging here can, right? But what we want to see is that, okay, it will, over a long period of time, it will go up already. And who can make sure that you are able to time the low, right? And that low could be this point here, right? Or it could be already this point here. If these things just from here, just zigzagging and up, right? I mean, all this low, right? You won't be able to time it perfectly one. But what we can know is that if you just zoom out and then just look at the long period of time, as long as those business, right, they are doing well, they are having good return on capital, right? This chart will just continue to go up, right? So I would say that like what Miss Billions just said, right? DCA help you with your emotion that you don't want to look at all this short-term zigzagging. What you want to see is that, okay, I'm owning good assets and good assets appreciate over time, right? So simple, right? I think this is really, really important. But I think sometimes for especially for new joiners, they just can't help to pay attention to all this short-term noise and all the media that try to guide you towards short-term, guide you towards like looking at today's news, right? I think this is something that you need to aware of because they have the, they have the incentive to make sure you look at short-term and not the long-term, right? Yeah. For Miss Billions and myself, we are in the same camp that try to tell people that actually just make sure that you focus on the long term and don't be too disturbed by all this volatility. Okay, I think I have commented this one I also commented already. Like seems like everyone around me is holding off on buying any more stocks until at least FOMC is over in May. Market capitulating in the next few weeks. I don't think it will capitulate. Market already priced in. They could. I mean, volatility is yes lah. Capitulating no. This word capitulations, right? You need to see if it dropped by 30%, then I also will be shocked lah. I don't think that will happen lah. But people always look for some assurance, like I want to make sure things are okay, then I buy. But at the same time, they are not okay to buy at a higher price. So this group of investors, they will tend to have huge amount of cash, and the cash is always earning a lower return, and they don't realize how costly it is to hold that cash for a long period of time. You just look at stock market chart over like 100 years, right? Anyone who is like just look for assurance, right? They are stuck between two kind of environment. Number one, the market, the environment is so bearish, and there's so much uncertainty going on. For example, like Ukraine war, during COVID period, during market tightening period, all the bad stuff, right? So they don't invest. And then another group of another scenario is that there are relatively less concerning stuff happening, right? But the price just keep going up and up and up, and it looks expensive. Then they also don't invest. So over time, they just underinvest and just get a very low return on their capital, and they don't realize the cost, the opportunity cost. I think that is a much common and bigger mistake. Just need to be aware of that. Okay. Let's move on.
Can I add something?
Sure.
Yeah. So I think I saw some YouTuber talking about this topic. I think it's a very generic topic that people come out and say, should I buy? Should I sell? Should I do short-term trading to earn more money and do not hold? I guess there's a lot of strategy out there. But I guess one thing is also that there are so many news out there to tell you to buy and sell and do more frequent trading. In the end, just think about it. Who is the one who benefit out of it, right? I mean, it's the brokerage, it's the platform brokerage that you are dealing with. If you buy and sell, they don't care whether you lose or you earn money. So actually, in the end, it's still the brokerage who earn more money than what you think that you could earn from the system itself. And you have to be very accurate in terms of your timing, price, and the period that you hold for that. So in the end, you have to think about your strategy. Are you a long-term investor, or you are just there to get influenced by other people who just tell you, okay, just buy now and sell now, or to do a short-term tradings. So yeah, I think your own strategy, your own emotion have to safeguard it, have to think about it well before you do your investment.
Yeah, I think that's a good comment. There are too many all these news, right? Try to really influence you to do more things. Some YouTubers also, I think, the same. They'll tell you, sell this and then buy this, and just make sure that you have no way to escape, right? You just keep on like following his trades, right? And then he get all the views, right? And then that's how they monetize, right? So there's always things that people benefiting from whatever advice that they are giving. So I think that one you need to be aware of that, and I don't know. I think for me, I think you just need to find a way, a long-term strategy that really work for your own financials, because you're basically in charge of your financials, right? Please be aware of all this trap. Okay. Next one. Assuming if black swan happens in the next few months, how long do you think the market will crawl back the all-time high in December or January? Wow, there's even a time period here, so funny. Miss Billions, you have any view on this, or anyone else want to share on this?
If it's a black swan, means nobody knows. So if you know, it's not a black swan. And if black swan happens, it happens. Nobody knows, right? So how do we know? We do not have a crystal ball. If we know everything is going to be a sell-off, I think me and Boon Tee will be the next billionaire in next few months. How do we know, right? I guess these things, that's why we do not know. What we do not know, we do not know. We just have to see what's your risk appetite, and just try to invest according to your risk appetite. If you have spare cash, just keep investing. If you think you cannot lose that cash in the short term, then you just lower your investment amount. But for me, I will just keep investing. I mean, everybody says that 2008 is a black swan event. 2001, 911 is a black swan event. If I were there to invest, I will be very happy. I mean, come on, who is not happy to invest when there's a Lehman Brothers and you can buy Citibank at $1? You'll be if you buy just 10,000 shares, you'll be a multi-millionaire right now. So I guess that nobody knows what happened. Just keep investing. In case you're really so scared, I don't think that you should invest for long term. I mean, then you just hold on to your cash and just huck it in your pillow until the day that you die. I guess everybody have to take some risk to get some return. So we cannot be scared all the time, as one can just comment. I'm a very positive thinker.
Same here, optimist here. I think exactly your comment. I have the same view because black swans, right? I don't know whether I think people have wrong definition on black swan. Black swan is not something that some news that make the market drop like 5%, that kind of things, right? Black swan by definition is something that people don't even aware of. Like the kind of like what Miss Billion said, right? The things that you don't know that you don't know. So by definition, if this thing I don't know, how can I tell you like, okay, how will the market crawl back, or how long will the market take to crawl back, right? So I think this is like, I don't know here. But even if we don't, there are things that we don't know, doesn't mean that we don't invest, right? You cannot wait for everything to be known in order to invest. There's always uncertainty, and that's a risk, right? And if there's no risk, then there's no return. For example, if you say, okay, I want to know, you can actually buy bonds. That's exactly what bonds for, right? If you buy bonds, you actually know, like you know how much is the payout. You know how much it is worth at the maturity, right? All these are known. When all these are known and kind of guaranteed by, let's say, like US bonds, right? Guaranteed by the US government, you also have high probability knowing that they won't default, and then you will get the monies. When all these things are known, right, then the kind of return that you get is also like very low. So actually you need to embrace the uncertainty and be optimistic. Yeah, I think that's my add on that. Okay, this one jumped up already. Is it realistic to be able to make 6,000 per month doing options as advertised in YouTube videos without being too complicated? How is it done? I don't know which videos that you're referring to, but I think there are many different option strategy, right? Some people doing like view strategy. I think some people just, the theta gang, they will just buy, they will just sell out of money options and then just use the theta, just benefit from the theta decay. So there are so many different strategy, right? But I think in terms of the amount, I won't say this is like this is, I mean, if you can find a strategy that can consistently earn, let's say $60, right? Then you just scale up by 100x. Of course, you can earn 6,000 per month. So I think in terms of the amount, you can just scale it up or down depending on your situations, right? But when it comes to strategy, if you are doing that kind of strategy like selling out money call option or out money put options, right? Or you do wheeling, right? I think this is like taking advantage of the theta decay. You can get some returns, some consistent returns month over month. The problem is always that they say the tail scenarios happen, right? For example, if you go and short put option on Netflix and then just within one day it dropped by 40%, right? You will get burned for that kind of situations. But this kind of situation, you don't expect Netflix to drop by 40% every day for like 20 days in a year, right? So you likely, let's say you just do this strategy for like 3 months, 9 months, 1 year, right? It could be that you don't encounter any kind of freak situation like this. Then you can show that, oh, actually it's very consistent. Every month I get this kind of returns. But doesn't mean that the tail scenarios won't wipe you out. So I think that's the things that, it's always risk return. So with option strategy, sometimes it's easier to hide it's very easy to hide the risk because you can say, oh, I've been doing this for 2 years, right? Get this kind of returns, right? But they just need one big loss and could get wiped out, especially for selling put options. So need to be careful, I would say. Yeah, that's my comment. Anyone else want to?
Yeah, Billions here. I'm trying to help you here, so I get more airtime. Yeah, this personal experience, not my experience, sorry. A personal friend of mine who really well in options 2020 and 2021. I mean, he made options very well, and his strategy is I think wheel or something. So I did ask him how he did it. But in one of the unfortunate events, I think you guys know about the options for the oil options who went negative. Yeah, he went in at $1, and then he lost 100,000 in a night when he woke up. So he lost all his money in that night. Yeah, he wiped out like 100,000. So he was lucky in few years, but he was not lucky in just one trade, and that really wiped off his whole portfolio. So yeah, there are a lot of unknown also in the options, so you have to be careful. I do not say that people do not earn money, but you just need one trade to wipe off all your gains. Yeah, and it might not be too sustainable. Yeah, it's from my perspective. I do not trade options. I did try, but not good at it. So I do not want to comment much about other people. Some people might be really good in it, but most of us might not be so proficient in this in this options trading. So you gotta be careful. Yeah, it's like before you know how to swim in the swimming pool and become Joseph Schooling, you wanted to try to swim in the English Channel and swim for 10 hours to go to Paris or something like that. So yeah, you have not have the skill yet, but you try to gung-ho and try to get count, you know, to try it out and force yourself to do something which need a higher skill set than what you thought you could. So I guess that, and money is hard earned. Yeah, so you gotta be protective about your own capital. You cannot just lose everything just like that. Yeah, just have to a personal friend who really lost that much, and he cannot sleep for a few days. Yeah.
100K is really the entire portfolio. Like he lost his entire.
Yeah, he lost his. He had like 110,000 now. The day that he woke up, he have 10,000 left. Yeah, he cannot talk for a few days. He was too sad, too depressed. But he earned a very good money. But he was telling me that really scarred him also. Yeah, he saved a lot. And he's very highly paid. So he saved back what he lost. But he's now very conservative and put in SPI and QQQ, those type of index trading funds, because he say he have to be protective about his capital. He do not want to be, so speculative. I think maybe a man is more adventurous. I'm a lady. I cannot speak all, but for me, I'm more in the long term and not too speculative or too much of adventure in this type of fast money, because I think it's not sustainable. You can earn a lot, but you can also lose in one game or one options itself, and you lose all of them. Yeah. So yeah, personal friend is a very close friend of mine. I saw him, like, he's very depressed. Yeah.
Yeah, it's always tough, right? I think that situation is really. Sorry, some echo. Can I speak? Hello, testing. Okay, thanks. Yeah, I think it's quite tough for that kind of situation, and I think that's the first time that it went negative, if I'm not mistaken. Because I also look at the chart that day, like the day before, right, and then notice that I mean, then the next day when it shows that the price dropped to negative, I was so shocked.
And when before he slept, he saw just $1. How can he go, right? So he just bought I just bought 100 units. I mean, how can he go? He thought like, how long? I don't know. I guess lah. So.
Okay, I think Miss Williams, I think you are breaking up already. Connection is so good.
Bounce back.
You are breaking up already. Connection is so good.
Sorry. Yeah. Yeah. How many can bounce back? After losing all. Yeah. Just my thoughts. Yeah.
Okay. Hope that he's strong. Okay. All right. Then next one. Why people buy government bonds for 2 to 3% when inflation is at least 5%? Isn't that aiming to power loose? Yes, correct. Buying government bond at 2.3, inflation is higher than that, then power loose. I think agree with that. But this is all about like portfolio allocations, right? Because even for stocks, it's always volatile, right? Some people may need the money, let's say in the next 1 year or next 6 months. They have no choice. They can't put in the stock market because of all this huge volatility, right? So the only way that you can put it somewhere to protect your capital is some short-term bonds, right? So I think this is about portfolio allocations. So for sure, there will be people buying government bonds. Let's say if you are, for example, like if you are buying an insurance company, right? As you know, insurance policy, right? Then it is endowment. Sometimes if you look at the endowment policy, the insurance company can tell you, okay, there's guarantee of 2%. Then on the upside, you can get, let's say, 3%. How could they guarantee you that 2% if they put all the monies into equities, right? So that one also boils down to the portfolio allocations. The higher is the guarantee, right? And then the more money they have to put into bonds. So at least that will guarantee some returns, some low return in the worst scenarios, right? So that's the purpose of having bond in your portfolio. And bonds is always yielding lower than equities over a long period of time, just because of, like I mentioned, right, everything is known. You don't have risk in terms of the timing of the payout, the maturity of the payout, everything you know already. There's no much risk. Hence, it's very hard to lose money, right? There's some fair value loss. Let's say if you buy a long bonds now, because the cash flow is actually fixed. The payout is actually fixed. What is not fixed is how much people are willing to pay for that bonds, right? So if you buy a 30-year government bonds, you buy now and sell next month, you could have a huge loss just because of the price, or you have a huge loss just because of the price or the yield that's fluctuating. But how much cash flow that's associated for these bonds, right? They are all fixed. So that's why it's known as safe assets. They are safe. Okay. So you're right if you are thinking that it is bound loose. Yes, I do agree. And if the inflation is 5%, actually bonds shouldn't be 2 to 3%. It should track with inflation also, because if the inflation is 5%, right, I think bond yield, you want to be compensated at least on the real terms, right? So the real yield by right should be 0%, right? But the situation now is that there's so much liquidity still in the market because of all this Fed pumping, right? Hence, they artificially drive down or push the yield down to like now, let's say around 3% for long bonds, right? But the inflation shoot up because of the situation that we also discussed, right? All these supply chain problem and so on. So I think this bond yield, as the Fed doing all this slow motion rug pull, right? I think this yield will continue to go up now. So it might go up to 3 to 4%, and then hopefully that will cool down the inflation from, let's say, 8% down back to 5 or 6%, right? And that is a much more healthy environment. I think now we are still in the adjustment phase. Okay, just short comment on this. If no comment, we'll move faster because I think we just have a few more questions, and now it's already 12:10 already. Okay, next one. Dow Jones proved to be most resilient market year to date. Time to play safe by moving there now. I think my answer is no for this, because actually Dow Jones, not many people are looking at this. I think people are quoting Dow Jones mainly because Dow Jones is around for many years. It's even longer than S&P 500. If you're looking for data that is, let's say, like 100 years, right? Actually, you can refer to Dow Jones, because they, in the past, let's say 100 years ago, I think only Dow Jones available. S&P 500 also relatively new. I would say if you want to play safe, or you want to have really a more neutral kind of allocations across sector, right? You should just go for S&P 500. It is good enough. Dow Jones actually has lesser names as compared to S&P 500s. So I think this is a no-go. This is just for, I don't know, like for historical reason, they're still here. But it's not a good proxy for the stock market, just because the number of names in Dow Jones is even lesser, right? Yeah, I think that's it. Next one. Hello, Boon Tee. Can share some of your views on Fed plans from FOMC? I think this one I will give updates whenever there's minutes or there's any, let's say, updates. Just pay attention to the tweets that I share. Sometimes I just put it in a short summary in the form of tweets, right? So usually quite short one, so don't take up so much of your time. But if you want to know how much, how high is the returns, right? You can look at the, the CME website, right? I can tell you from now until end of the year, they will hike the rates by around 2 to 2.5%. 50 basis point hike in May, another 50 to 75 basis point hike in June. So we are talking about 1% or slightly more increase in the Fed fund rates from now until June. We're talking about 2 months' time, yeah? So any one of you have mortgage, if you can refinance, please refinance. Check with your mortgage broker, see they can get good rates for you. You need a referral, can just PM me. I just talked to my mortgage broker in the past 1 or 2 weeks. So I myself am going to refinance my mortgage, lock in a fixed rate for some longer periods. Because this yield increase, right, is not a magic, right? They have been communicating it. The reason they've been doing that is also because they don't want to shock the market. They don't want to say, oh, I'll keep quiet, then suddenly I just announce a 50 basis point hikes, right? So they have been doing that in the past, and then the market sometimes panic, right? When they lose the, they don't have a feel anymore. They feel that this Fed can do whatever they want. It's a bit like China situation, right? The uncertainty sometimes is more scary than the actual interest rate hike. So that's why in the past, let's say 2 to 3 years, they've been, they try to communicate. That's why you see when the real announcement came in, right, market it doesn't react too much already, because throughout the speech they have been given, right, they already prepared the market to see this kind of development of interest rate. So if you want to remember something, yes, 200 basis point hike or more from now until end of the year. So very painful for those who have high mortgage amount. Okay, next one. What happened during a margin call? Your broker will just liquidate on behalf of you. Quite simple, right? Say you have positions and then you leverage so much. Usually before that happens, they will tell you first. There will be emails sent to you say that, okay, please sell down or pump in more cash. If not, anything wrong, we will liquidate. Or we might already liquidate if you don't do that. So there's rules. I think the rules, depending on how fast or what kind of communication, I think sometimes there could be some details that is broker specific. So you might want to check with your friends using the same brokers, right? But if you are not sure on this, right, if just always veer on the safe side, meaning don't leverage so much to the extent that you will hit with this. No, it's not fun one, because sometimes the intraday movement is so serious that they just liquidate at the worst moment, and then they just bounce back hard, right? So become a permanent loss for you. Because you want to buy back, pump in cash to buy back, also you are buying back at a higher price already. They will sell without your permission if you hit this margin call at the worst price. So it's very bad. So please play on the safe side. Okay. Anyone else out until now? Anything that you want to share? Because if not, I'll move a bit faster. Just quickly go through some of these questions. If not, we will just move faster. I don't know how to pick up stocks, but I know how to pick good investors. My return is 16.5% for the past 10 years by following the best. That's good enough. Now, I think this is fair, right? I think, let's say, looking at the S&P 500, they are doing 12%. QQQ may be slightly higher, but I need to check, right? But let's say if you know how to pick good investor and that give you some good returns and you're just happy with your returns, you are on track, right? I think that's just continue doing. I think 16.5% for the past 10 years. I think this is good result. I wouldn't say you need to get 20, right? 20% is already really godlike level. Yeah, but if you can share which investor that you are following, and then what kind of portfolio that you're having, if you are able to share your top 3 names and why you are bullish on those companies, then we can have more details discussion, right? I think this is definitely good thing to discuss, and then we all can learn from you also. All right, thanks for this comment. Want to add stocks, but with earnings coming plus May rate hikes, feel unsure if should wait know that market timing isn't recommended, but can't help feeling this. Yeah, I think when it comes to the feeling, right, even for myself, right, I every day have feelings, one. I look at the market drop, I will have feeling whether it will drop more. I look at it bounce back, I will have feelings that this trend might continue. All this feeling keep coming in, one. We can't stop the feeling, one. But I think feeling is one thing. Another thing is you can't really rely on your feeling. Because if you observe your feeling, right, one thing you can do is that you write down in your journal on what do you feel. You feel this, you write down, you feel bad, feel good, you write down. You just write down and you read back your journal, you'll find that actually your feeling also keeps swinging. Man. I think this is true for everyone. But the things that we can rely on is the system, like what Billions shared, right? If you have system to DCA, right, then your actions actually rely on your systems. Then you don't have to rely on your feelings. If you trade based on your feelings, then you will trade in and out just because your feelings in and out. Your feelings swing up and down. So I would say have a system that is working, then rely on the system. The feeling cannot be relied on. Yeah. So that's why if you ask for my opinion, sometimes whatever that I say, right, is my feeling, right? But if you want to know how my portfolio doing, I would say go to this, look at my transactions, right? You see, sometimes, of course, there's some portfolio reallocation, but most of the time, these columns, right, they are positive, right? See, I'm DCA here and there, DCA here and there, DCA here and there, right? So I think the system of DCA, this is a system that's working. It's not my feeling that I think that TSM already bottom here, that's what I buy. That's not the case, yeah. The situation is that, yeah, it's just DCA here. Okay. Next one, macro outlook so far looks pessimistic. China housing, governance not having clear rule of law, Ukraine war and proxy wars. Should we hold cash now? Long term, no. As simple as that. Just imagine that we are having this discussion during March and April 2020, right? Everything is wrong, right? Everything tell you that you shouldn't invest, right? And then market just going up, right? Why? Because I mean, stocks is just superior, right? Just look at the business. The business have ROE or ROIC of, let's say, 10, 15, 20%. Over long term, how to beat that, right? By putting your money at cash? I don't think so. But if you put your money into the stock market, and if you can't sleep, then you just have no choice but to put in cash. Because I would say that between equity and cash, of course, equity is better. Oh, and I need to caveat that that's a long-term perspective. But let's say between have a good sleep versus have a better return, because you need to all in into equity, right? I would say a good sleep is more important, because if you can't sleep well and then that affect your health and you need to see doctor and then you get into depression, wow, I think that one is confirmed much more costly than whatever return that you can get from equities. Because if you are getting into depression to the extent that you are no longer productive and you can't operate, right? I mean, you lose your life, right? I mean, that's more precious than equity returns, right? Yeah. Need to take care of your psychology, your emotion as well. And this is really up to individuals, one. Like if you are like Billions and me, right? I mean, we are optimists. Just the first question, what's your loss point, right? I don't even know I lost like 20% year to date until I check it this morning, right? Because I don't care, right? We are all looking at longer period of time. Do I need to care like whether I lose 20%? Even if I lose another 5%, I also don't care. My system is already running like has been running, right? That's why I share these things for whoever that's new, right? I won't say that this is a good system, but at least you can see that, okay, this is my approach. At least you can have some takeaway from there's someone doing this over time, right? So I think that's something that I can add values on now. Okay, next one. What is your opinion on Netflix? Opinions right now is divided about their recent earnings call, and what do you think about their plans? I don't know. Do we have time for discussion? Anyone want to share your views on Netflix? because in terms of my view, I already shared it on my video on Netflix already. I think, not so. Let's say if there's anyone want to discuss this one in details, we can have a short call, just talk about Netflix. I think this is interesting enough. And if needed, we can get Mr. He's not here, right? Mr. Loof or Luff from Australia, right? So we can get his view. I think he's very bullish. But the Netflix video that I posted on YouTube, right? There's one comment there. You guys can check it out. I think the person is quite bearish. It's not bearish about their plan. They're just bearish on the entire business model. They don't think that this is a good companies. And I know that Miss Maverick, also very bearish on Netflix, even before this recent quarter earnings. Maybe we can get his view also. Depending on that, if there's people want to discuss this, we can always have a separate call just to talk about this company. Okay, in terms of my view, I'm quite neutral about it. I think they are, of course, the story. There's some change in story. There's some concern whether they are able to switch back to growth phase and adding subscribers. I think there's some concern there, but at the same time, I think with their management team, I think they have a strong management team. I also think that they can navigate out of this, and whatever metrics that they are looking at, I don't think they are, pricing in a lot of growth there. They are free cash flow positive, right? So I don't think their valuation is so crazy, They don't need to execute flawlessly to justify today's valuation. They just need to get back to positive growth, then they are fine. So I'm on the neutral side. Next one. What is your view on ETF? Similarly, shouldn't time entry between S&P 500 and World Index ETF? What's your view on pro and cons? Preference? Yeah, I think together with, let's say, a couple of our veterans investors here, like Miss Billions and quite a number of people. I saw YCX also here. I think at least for our group here, right, we are not the bunch of investors that advocate for market timing. Doesn't matter you are doing day timing or short-term swing timing. This is generally not advised. At least us, right? There are other investors that they think that they can time, but this is not recommended. Yeah, that's on timing. Second one is between S&P 500 and World Index. I think this one, right, is really, how to say, this is what's your view on US versus non-US, right? If you look at World ETF, let's say we're talking about the IWDA ETF, right? Developed market excluding US, meaning you are talking about Europe, Japan, Australia, Canada. I think these are the main economies within the world ETFs. So I think there's a lot of argument also pro and con. But I think the main difference is that are you bullish on the names in S&P 500 relative to those in Europe, Japan? So I think S&P 500, relatively speaking, you have more tech exposure, right? Whereas for developed economy in Japan, in Europe, I really don't know. Maybe they have more into, all these LV companies and then some I really don't know. You need to look at their economy and judge for yourself. But I can comment on the tech, which we comment in at the beginning of today's session, right? So you need to make a relative assessment on whether, let's say, all these tech name in US companies versus the developed economies ETF. And I don't have much view on the world ETF. That's why a bit hard. I'm okay with either, for those who invest into S&P 500 or investing into IWDA. I think in terms of correlation also quite high. So I don't know whether that is very meaningful to have a debate on the difference between these two. Either way, we will do, let's say, if you are doing long-term DCA, I think that's my comment. But if you ask specific people, different people will have different view of regards to these two. Some people, they will say that whatever, how good is all these FANG names or how good is S&P, they are anyway priced in, right? So I just want a neutral view on neutral allocation across companies. Then I will prefer World ETF. I think that's a very fair assessment. I would say that's wrong, right? But at the same time, we will hear people say, okay, actually S&P 500, even with their relatively high PE, their companies is high quality and you should get the highest quality names, right? Then they will prefer S&P 500. I also agree. So you see, I don't have a view in short. But if we have anyone have strong opinions, we can list out a couple of points to talk about, right? Because you will talk about like, okay, whether US, whether there will still be the, the countries that's leading the world, right? Then people will debate about it. And then you have to bring in China as well. China become a world superhouse. Should we add in? Yeah. So there are quite a lot of debates, but I'm kind of neutral opinions. But we don't have so much time. I want to close the call already because it's 12:30 already. Last one. I saw your reply on TWT, Twitter. 20% market down, don't mean 20% capital liquidate to cash. I recall this tweet already. I think this is some discussion that I have with Terence. I think when Terence, you need to read Terence post first. So he has two posts, right, with regards to whether recession will come. I think his argument is saying that, you see, market drop doesn't mean that the money just gone, right? It just flow from somewhere to somewhere. It just flow from, let's say, equity back to cash. And then at some point, they will flow it back, right? Because all this money are sloshing around. Sometimes people are bearish and then they're just flowing around. So he don't think that this market dropped 20%. It just means that the capital is much lesser and hence this is tied to the recession, right? So I think this is his view. My view is that I don't comment so much on the recession, but I just want to point to Terence is that all this capital or liquidity that is sloshing around, right, it's not a constant amount. Because if there's any movement, any change, right, let's say if recession risks become higher and then there's less mortgage in the economy, right, or so-called less liquidity or less M2, right, if you want to get a measure to talk about it, right, as all this credit generation slow down, less people buying houses. Just take this one as an example. Actually, the liquidity in the market can reduce one. They can drop. So what I'm trying to say is that if the liquidity drop, right, you actually have less money flowing around. And hence, it is not totally, like as described by Terence, it's just flow around. It's not truly, it's not 100% true. Because if really people don't have this optimist view, and then like 2008 scenarios, housing market drop, right? House price drop, people don't buy sell houses, people don't take up loan, right? Actually, the entire money supply in the economy can calm down one. And that is not as simply as money just flow from equity to cash and then later it can flow it back, right? It's not as simple as that. They could actually become lesser and lesser. And if that's true, right, then you actually don't have liquidity in the cash that can flow back to equities. But this is quite complicated because we are touching about all this monetary, talking about economy, all these things. And it's not so important because when things change, it's not just one variable that is changing. Usually there are a couple of variables changing at the same time. So it becomes like a very complex kind of interactions. So not so straightforward. But the point that I want to point out is just that single point that it's not just flowing. Total credit in the market can go up and down. You just need to look at the M2 measures, right? Like during COVID period, the Fed just pump and then the Treasury just keep on doing all this stimulus check, right? What happened is the credit can go up, the money can go up. But whatever they have done, right, they can do in reverse. So that's why don't say that any credit or any money that has been created won't disappear. One, it's not the case. One, it's much more complicated than a simple narrative that people are painting. Yeah. Okay. Long answer again, but even for a topic like this, right? I can give my opinion, but I cannot give a very coherent kind of like economic 101 that can address all this, because this is so much complicated than, let's say, looking at specific stocks, Specific stocks, we can still look at like, these are the key points that people are talking about. For Netflix, it's so simple. If they can add subscribers from next 2 or 3 quarters, right, I can assure you that the share price will go up. The harder part is to judge whether they can increase subscribers or not, right? That's the harder part. But at least you can pinpoint to a specific area and just comment on that. But when you look at economy that are so big, so complex, it become very fuzzy kind of discussion. So that's the hard part now. Okay, 12:30, try to keep it short because I don't want to take up so much of you guys' time also. When we start doing all this and talk non-stop also, sometimes, the noise become much more compared to whatever good takeaways that you can take, right? So I also don't want to take up so much time now. Okay, thanks a lot for all of you joining here. Actually, I'll say that I saw Maximus is here, BDS is here, Martin is here, right? I know you guys can share your thoughts also, right? So next time, I think if we have any interesting, I reach out to you guys first and then see we have more, some dedicated topics to talk about. Let's say for Maximus, I believe you can talk about all these risk topics, right? Then we will have that kind of dedicated sessions rather than me, just one single person chit-chatting, become a DJ radio already. I prefer to have a more interactive kind of discussion. But now I need to clear up all the questions. And I'll say for today's, thanks a lot to Billions for your insightful comments. Especially some some story that you just shared, right? I think people can learn more from all this story than from theory. Theory, you just go open up Wikipedia, anyone can read, right? But usually these are all this story, not just story. This is really true incident, a true experience that someone has encountered, and they are happy to share with you, and you share with us. I think these are something that one person made the mistake, but you can have 1,000 people that listen in and can imagine the situation and can learn from it, right? So I think this is definitely helpful. I think that's all for today's. Miss Billions, any closing statement that you want to give? If not, we will close the call now.
Yeah, nothing. I guess in the end, just keep investing. I mean, if you have 15 years to 20 years time of, runway to invest, I guess this is just a little choppy price range that we'll see. It's just like the ocean. When you are in the deep ocean, sailing further away, the sea is calmer. If you are nearer to the shore, the wave is always bigger. So the further you go, the longer runway. Yeah, I guess it's just a price range fluctuation. Don't get so emotional about it. Yeah, unless there's some money that you cannot lose, then maybe you have to think about your risk appetite and your strategy again.
Yeah, I think that's a good closing statement. Okay, there's some echo. Okay, but anyway, we close to today's call already. If there's any topic that you guys want to chat about, we can just let me know. We can always schedule session and have long discussion on any specific topics that you guys are interested. And for today's, thanks a lot for all the joiners here, all the members, and see you guys back to the group. Yeah. Okay. Thanks a lot, and enjoy your Sunday. Bye-bye.
Bye.